Hey everyone, welcome to episode 1 of SDR Finance's new podcast, Cash Chronicles.
Hello, everyone. My name is Ken,
And hi everyone, my name is Sarina.
and Ryan is also here in spirit, but he sends his well wishes.
And today we'll be talking about one of the most diverse issues within economics. A stock is a share in the ownership of a company, giving a claim on earnings and assets. Stocks are also called equities, and buying shares grants privileges like receiving dividends, which is basically income.
Generally speaking, when private companies sell shares to the public, they do this through a process called going public, meaning that the company makes these shares available for purchase on markets. That's called an initial public offering or an IPO. And during IPO, the companies announce the amount of shares that they're selling and they set the price for those shares. And any funds raised go to the company, less a small holdback for whoever organizes the IPO. And these stocks are sold on two markets, basically. You have a primary market, that's where IPOs go, basically. And then when those shares are bought and sold and circulated around again, they go on the secondary market. That's the stock exchange. So if you go to, say, the NYSE right now, right? You buy stocks from there, you're basically just buying from a secondary market.
Companies also have many different classes of stock options, from A, B, C, for example, with varying voting rights to help founders maintain control of their company. For example, Alphabet, the parent company of Google, has Class A, Google, which has 1 vote per share, Class B, which has 10 votes per share held by the founders and which is not publicly traded, and Class C, which has no voting rights, which is held by employees and common shareholders.
Now, listen, folks, stocks are a good way to diversify investment portfolios. In fact, I highly recommend you have some stocks in your investment portfolio. But it's important to note that as humans, we can't time the market unless we have insider knowledge. And when you buy stocks, right, the stocks will naturally fluctuate up and down, and that is to be expected. But what you're really looking at is the long-term potential of those stocks. And that's why investors also buy stocks from various companies across various different industries, right? Because different sectors will perform differently over time. And also, that's just risk avoidance 101. So, for example, in recessionary circumstances, right? Generally speaking, commodities will tend to do better than, let's say, banking stocks, right? Just something to keep in mind.
And the stock market as a whole serves two main purposes. Firstly, it helps companies raise capital, making income or money by sharing shares of it to the public for business expansion. And secondly, it provides investors a chance to share in the company's profits.
Investors can profit from stocks in basically two ways. Number one, like Sarina said earlier, is dividends, where regular payments are made per share, and that provides a small return on investment. And generally speaking, this is probably only going to be a few percent a year. The real money, if you will, comes from the capital appreciation of those stocks, which is when the stock price increases and you realize your gain by selling those stocks off. Congratulations, you've just made capital gains. And generally speaking, if you buy stock in a non-registered account, there will be some capital gains tax to pay, but we will be sure to cover that very, very shortly. Like now. Okay. So now that you know what a stock is, let's discuss how to buy one. And the first step to doing so is basically opening an account. You'll need a direct investing account with a brokerage, and this brokerage can be your bank. It could be something like Wealthsimple, et cetera, et cetera. And the stocks, by the way, they can't be purchased directly from companies or stock exchanges. You have to go through your brokerage to facilitate the exchange. And just an FYI, minors in Canada under Canadian security law cannot directly buy stocks on their own. So something I see very often is kids usually use their parents' TFSA or other investing accounts to buy the stocks. And then once the kid reaches maturity, parent will just sell the stock off and transfer it to the kids, like so.
Okay, so there are many different types of accounts to cover. First of all, we have the RRSP or Registered Retirement Savings Plan, which is used primarily for retirement savings. This is an account where you want to put in money so that you can wait until you're retired and gain enough money to live off for the rest of your life. It allows for tax deferral on investment returns, which is beneficial when withdrawing in retirement when you're at a lower tax bracket because you have no main source of income. Contributions are also tax deductible, and however, you cannot withdraw your money easily without incurring significant fees.
And just to clarify what Serena just said, you can't when she means you can't withdraw your money, it basically means that you can't withdraw your money before you retire. or you hit that retirement age. And then something else to consider about the RRSP is that unlike the TFSA, which I'll go over very shortly, there is no set contribution limit. It's not a fixed dollar amount. It's based on your income. So if you have no income that year, you will not make any contribution room in your RRSP. Now, if you want more flexibility, what you should be considering is actually a TFSA, tax-free savings account. And this is suitable for both short-term and long-term savings goal, whether it's funding your next vacation or buying a house. And what this basically offers is tax-free growth on savings, which is, say you have stocks, say you have term investments in that account, and if those things appreciate, if they get interest, they pay dividends, they will not be subject to any tax in any form, hence the name.
Okay, cool. Next, we have a margin account. Margin accounts increase buying power by borrowing against the value of your existing securities. This enables advanced strategies within the stock market like options trading and short selling, which we'll cover later in this episode. However, there is a higher risk when you have a margins account due to potential losses alongside the potential for greater returns. This account probably is not suitable for all the investors, but it's a great option if you want to attempt to take on some more risk within the stock market.
And finally, and basically the last one is a cash account, otherwise known as a non-registered account. And basically this you should only really be using this account if you go over your RRSP and your TFSA contribution room, because whatever you put in this account and whatever gains happen, it's going to be taxed at the usual rate, basically. And it's basically, in terms of what you can buy in the account, it's the same as any other account. You can buy stocks, GICs, etc., etc. Same thing.
So you might be wondering about how to consider which stock to buy. There are, I believe, three main factors to consider. Firstly, obviously, it's its future value potential. What this means is that you don't want to look at how a stock is performing right at this instance. You want to think about how this stock will perform within 10, within 15, or even 5 years from the current moment you've bought it. For example, if I wanted to buy stocks for, say, face masks, then I would not just consider the value of face masks holistically right now during this time period. I would want to think of future demand. Will the market for face masks grow and expand, therefore allowing me to gain more profit on my investment? Or will it kind of collapse as, for example, the pandemic is over and people aren't really buying any more face masks? Therefore, you want to consider your future potential, the future potential of your investments and all the money that you've put into it. Secondly, we want to consider the stability of the company. A company might seem like a great decision to invest in with a lot of future potential within the market, but however, realize that the potential within the market is not the same as the stability of the company itself. A company can be in the field with a lot of potential, but still end up failing. For example, we have a lot of investment bubbles that have happened. For example, the real estate bubble or the dot-com bubble that burst, in which a lot of companies were doing very well financially. However, but were taking on incredibly risky business strategies that ultimately led to their downfall. And thirdly, which while not being as much of a concern for investors, you might also want to look up into ethical considerations of the companies that you're investing in. Some companies, like for example Nestle, Nestle, sorry.
Nestle, really?
Nestle? No, wait, it's not.
Nestle, no?
No, it is Nestle. Huh, I've been gaslighted. Okay, yeah, you're right. Nestle are very fantastic stock options to invest in. However, Nestle has had a horrible right track record, in particular, alluding to child labor. So if that's something that bothers you, then you might want to consider withdrawing your money or not investing your money at all into that corporation and perhaps choosing a more ethical corporation.
Yeah, same thing happened to Starbucks recently. I hear that they've been offering discounts on their coffee ever since people started boycotting them.
Oh yeah.
It's crazy. It's crazy.
Oh, I think it's due to the union busing that's been going on.
No, I think I don't know the full story. I believe they support
Oh, yeah,
it's due to the war in Gaza
yeah,
apparently.
the
They
Palestinian war.
they support the Israel, so people are
Oh,
basically boycotting them. It's crazy. You would never expect them to offer discounts because the brand is about being, premium, but here they are offering discounts because no one's going to their shops. So it really goes to show you, if enough people can get on the bandwagon, um, you can basically shut a company down, Consumer
Like
without,
yeah,
without the consumer, the company is nothing. You need consumers and you need business.
yes, exactly. If
That's
you
just the way it is.
if you have the best company in the world, but consumers are not willing to buy from your company due to ethical concerns, due to moral concerns, then well, you simply won't have that company anymore. Like the stability and the quality of your product is important, but marketing plays a huge factor within most decisions that consumers make, even today.
Absolutely, absolutely, without a doubt.
Mhm.
Anyways, in regards to actually buying the stocks, basically there's two ways you can buy. There's two sort of orders you can place. The first order is called a market order, where you basically tell your brokerage, okay, I want to buy the stock ASAP at whatever the rate is. Now, there's a risk with this because some less liquid stocks, let's say that aren't traded as frequently, there may be some variance between the price at the time you put the order in and the time that the order is fulfilled. Just something to keep in mind.
You can also do something called a limit order, in which you set a maximum price or a minimum price for selling. Basically, for buy orders, the purchase only occurs if the stock trades at or below your limit price. For sell orders, the stock only sells if it goes above your maximum price. This is particularly useful if you ever want to trade stocks sort of with less control on it, in that you can automatically buy or sell stocks as you believe the market is fit for that kind of stuff. However, there are a lot of risks for doing so, in that if the market crashes or something else happens to your price, you might be coerced into buying a lot more or selling a lot more shares of stock than you actually want to. So you should help this by using the current market price to help establish your limit. And finally, after that, what you can do is place your trade. You want to place your trade and execute your chosen order, whether it's a market order or a limit order. And finally, just enjoy the benefits and risks of the stock market.
And just remember, nothing is ever set in stone until the company says, yes, we have fulfilled your order. So you can place it, but it might just take some time to fulfill. And by the way, the fulfillment only happens during trading hours. So if trading suspended, or if you do it on a weekend or a public holiday, you won't have it fulfilled until, the time that trading resumes.
Yeah.
And finally, moving on, something that's different to talk about is GameStop. And this stock was actually, it's known as a meme stock, but I'll tell you the story. So basically, a very talented security analyst noticed that the stock was heavily shorted, which meant that traders had borrowed to buy the stock and then sold it, and then later bought it back to cover up and borrow. And he did the math and figured out that if the stock went up and the traders were forced to cover, the price would absolutely skyrocket. And he talked about this on Reddit and YouTube. And Reddit, being Reddit, thought that this was an amazing opportunity for a short squeeze, and they started mass buying, and the Reddit users started mass buying the stock and pushed the stock again well past any conceivable appropriate valuation. Basically, the stock was overvalued.
Yep. And just to clarify a bit on this topic, while Ken and I and Ryan are interested in finance, we no way claim to be completely expert or knowledgeable on these sorts of issues. The GameStop situation is very complex. I think there even is a documentary about this on Netflix, so check that out if you're interested. But we'll try our best to explain some of the complexities of the GameStop situation and also give some general trivia about this situation. Okay, to explain, shorting a stock involves borrowing stock from someone else, immediately selling it on the market, which is your main income on the short, and then hoping the price comes down. Later, you buy the same amount of stock back from the market at a lower price and return it off to the original owner, presumably with some thank you cash bonus to go along with it. But however, if the price of the stock were to go up instead between the instance where you sold it and got your income and got your profit, and when you're trying to buy it back to give the shares back to your friend or whoever, well, you still have to buy back these stocks to return them. And now instead of having a profit, you gain a loss. And in theory, there's no real limit to how much you can lose or gain, depending on how high or low stocks can go.
And basically, and I want to make sure that this is extremely clear, GameStop basically broke every single rule of finance. It's like this is what meme stocks do, and meme stocks are basically stocks that gain like a lot of viral popularity basically through social media and online forums. And Reddit, they really did the stock. They really made it a meme stock, and meme stocks usually experience very volatile and very rapid price movements. It could be all the way up, then it could come crashing down just as fast. And I want to make sure this is very clear. Again, this does not usually happen. It's not supposed to happen. But then again, there are always exceptions to the rule. And long and short of this, pun intended, one of the largest short sellers basically got out near the start of this, and they ate substantial losses for doing so. And then later on, they had to be acquired by Citadel to get themselves out of that sticky situation. And basically, yeah, the stock price continued to rise as Reddit did not believe what anyone was saying. And basically, they created, in short, the largest pump and dump scheme in history, whether intentional or not.
Okay. To clarify a little bit for people who might not understand what Citadel is, Citadel LLC, aka Citadel Investment Group LLC, is an American multinational hedge fund and financial services company. Okay, basically, it's an alternative investment manager working on behalf of some of the world's most prominent clients, and it's a huge company. I think it has more than $63 billion in assets as of right now, as of the time that we are recording this podcast, which just comes to show how big this entire GameStop situation was. And also to clarify a bit more, I don't think the situation can be described as just Redditors decide to go all out on buying stuff. There were a lot of conflicting forces on base. Some people were in for the profit, some of the people were in for the lulls and for the memes. Some people were like on both sides just working to make this stock go higher or lower depending on their own effects. And the general consensus was there was a lot of chaos surrounding GameStop and like meme stocks as a whole during that period of time. Okay, so after like all of this happened, the massive volatility of the stock market caused a wide variety of effects. Many brokerages, I think you've heard of Robinhood on the news, allowed the traders to operate on margin, but did not tell them it's margin during the settlement window, which is extremely controversial. Because of these factors, as well as instant deposits that Robinhood allowed, Robinhood itself could not actually meet requirements during this phase, and it was forced to suspend buying for a few hours while it scrambled to secure loans to cover collateral requirements and to turn buying back on.
And basically, by the way, Robinhood is a brokerage like Wealthsimple. It's the American version of Wealthsimple, if you will. It's basically low-cost trading. And what Sarina means by scrambling to secure loans to cover the collateral requirements is that brokerages have to have a certain amount of money on hand. That's federal law in the US. And if they don't, you can't trade. And it's very risky. And in fact, some of the factors for that actually happened after the Great Depression when banks, and this comes back to the whole concept of liquidity, which is that banks, brokerages, you need to have a certain percent of all liquid cash. You can't put them and lock them somewhere else. If there's a bank run, and you don't have the money, that's an issue. All right.
So I think that's it for today. Thanks to
Pretty much, yeah.
Ryan and Spirit for attending this podcast, and thank you all listeners for tuning in.
All right. See you guys next week.
Bye.
Ciao.